Hello, this is Clark Kendall with Kendall Capital. It's mid-November. We have 6-7 weeks left in the year. What I want to do, though, is talk about there's some dramatic tax law changes happening in 2026. There's some things we can do going into the end of the year, and some of the things will affect us clearly in 2026. But let me tell you what we're thinking about. The standard deduction for those who do not itemize, it's going up to $31,500 for married couples. For singles, it's $15,750. One of the big things that's been in the news quite a bit is the SALT deduction, what we pay for state and local taxes and mortgage interest. Now has gone from $10,000 to $40,000. But I will caution you, there's a phase-out provision for those singles who are making more than $250,000, or for a married couple making over $500,000. I think you just need to be conscientious about that. There is next year in 2026, there's an extra deduction if you're over 65. So when you turn 65, you get the benefits of Medicare, but you also get this extra deduction. It's $6,000 for a single, $12,000 for a couple. Here again, though, there's a phase out for an individual. If you make more than $75,000, that deduction phases out. $150,000 if you're a married couple. Estate planning issues have not changed really. It's $15,000 per individual. The ability to pass on assets to your children and grandchildren with no estate taxes. It would be $30 million. We really don't have many middle-class millionaires with $15 or $30 million, so it doesn't affect them. But I will point out the District of Columbia has a $4 million estate tax. Anything above that is taxed. The state of Maryland has a $5 million. They're the only two jurisdictions in our entire country that have state estate taxes. And Westmore has proposed lowering that to $2 million, but right now it's only 16%. One of the other big things that's changing in 2026 is the charitable deductions. You can still give charitable deductions, but they have what they call a phase out. If you make more than basically $500,000, if you're a married couple, they have a 0.5% deduction. So let's say, just talk round numbers. If you make $1 million and you gift $50,000 to a charity, $5,000 of that will not be deductible. So it's a nuance. You got to be conscientious of it. If you're charitably inclined, you might want to step up and make charitable donations either through your donor advised fund that so many of you have participated in. Let's talk about retirement accounts. As retirement accounts, the tax laws are changing. About half the assets we manage at Kendall Capital are in retirement accounts. The contribution limit is increasing from $23,500 to $24,000. The catch-up provision, those of you who are over age 50 now can contribute an additional $8,000. But in 2026, that needs to be Roth. They don't allow you to do it pre-taxed anymore. And then there's a unique feature. It's called the super catch-up. For you individuals who are age 60 to 63, you can actually contribute $11,250. That also must be Roth. Don't know exactly the reason why they changed it, but we do know the rules and regulations, and we need to plan accordingly for that. The 529, many of you have been very diligent about making 529 contributions for your children and grandchildren. Giving individuals and children education is one of the biggest benefits. The contribution limits haven't changed, and the distributions to higher universities, higher education has not changed, but they have changed the distributions to K-1 to K-12. This year it was only $10,000. Next year we can distribute up to $20,000 a year to to K through 12. You can also distribute for professional designations such as CFP, CFA, CPAs. The list can go on and on. So there is a great opportunity along those lines. But anyway, you know, going into the end of the year, myself, Carol, Dave, and now Adam Platt, who joined us just 2 months ago, we're here to help you talk about and strategize going into the end of the year. So please don't hesitate to call any of us with your questions. Thank you.